What's your take on the government intervention, how much tools they actually have?
So I think there's two issues. There's one which has to do with the economy. And can the Chinese government soft land its economy without a big disaster? The answer is yes. But there's another question, is what to do with financial bubbles in the Chinese economy. There are pockets of excessive risk-taking, and that is harder. So the stock market is part of it. They have fallen into the same trap we fell into, which is to encourage an activity. In our case, it was home buying, which has social benefits, and it goes too far. They encourage share buying, stock buying, as a way to spread the market economy, and it went too far. So I think that the Chinese will succeed in soft landing their economy, but they're going to have a lot more problems soft landing their financial market.
What does Chinese soft landing their economy look like when their economy is more geared towards services and consumption rather than the old model of investment and exports?
And that's a great point. It looks like an economy that grows at 5.5% to 6%, not 8 to 10%. It looks like an economy that reorients its growth engine from the external to the internal. And it's one that's going to be less smooth than it has been in the past. But this is part of their process of development. It's the so-called middle-income transition. It's tricky, it's messy, but they do have the tools to deliver on it.
What does that wind up meaning for the currency? Because part of what we've seen is a slight recovery today of the yuan onshore, the official rate. But offshore, we're still seeing a declining currency, and that gap needs to narrow in some capacity. And what's the ripple effect there?
Yeah, and that is the big tug of war between China's domestic objectives and its global responsibility. In terms of its domestic objectives, it wants to weaken its currency. That is a way of assisting growth and making the transition less traumatic internally. But in terms of its global responsibility, the more it weakens its currency, the more it steals growth from the rest of the world. So it's torn between the two, and what you see is it tries to weaken its currency till it reaches a tipping point that causes global disruptions. Then it slows down a little bit, appreciating it a little bit, but then it will start weakening again. So you're going to see this tug of war play out through most of 2016.
And just to illustrate that, if you want to come inside the Bloomberg terminal, you can take a look at what has been happening to the yuan. Of course, the higher it goes, the weaker the yuan is, because this is against the dollar. And the white line is the offshore rate, continuing weakening in the yuan, Scarlett, where, yes, you see over here that yellow line is sort of falling, which means the yuan is strengthening. So really pointing out the struggles that the PBOC faces.
And, of course, China has banned some foreign firms, some foreign banks from capitalizing on that rising gap. So, Mohamed, you mentioned how China is stealing growth from the rest of the world. Does it set us up for a regional crisis? Because there's a school of thought that the 1997 Asian financial crisis began with the yuan devaluation of 1994. If the yuan is again on a path to more weakness, what does that mean for the rest of Asia's China's trading partners?
So the rest of Asia is trying to adapt to a China that grows less rapidly and that also has a depreciating currency. But what that really speaks to is not just regional, it's global. The biggest problem is that the world is yet to find sustainable engines of higher growth. And because of that, we struggle. And because of that, we cannot fully validate financial asset prices that have borrowed growth from the future. So what it means is not just having to adapt economically, it is that we are looking at a year with a lot greater financial volatility until we get the comprehensive response on the policy front. And unfortunately, the probability of that happening is quite low right now because of political dysfunction.
And obviously, this is going to be a huge topic for all of 2016. But the other one here in the U.S., it really has to do in the investment-grade corporate bond market. If you come inside the Bloomberg terminal, I'm tracking the Bloomberg investment-grade corporate bond index spread. And you can see it has somewhat blown out, but we're still far below the levels of 2011. At what point do you start to be very concerned that we're going to see a sell-off in credit and equities?
So had you shown the high yield market, you would see an unhinged market, just like energy is, just like emerging market currencies have become. Not the case for investment grade. Having said that, investment grade has the same issue that these other markets have, which is they were on the receiving end of massive flows of capital looking for yield and stretching for yield. And what you're going to see is a process of normalization. The hope is that fundamentals improve quickly enough, both economic and corporate fundamentals, to limit the widening in the risk spreads. But there is a risk that that becomes also a destabilized market, because a lot of people have stretched enormously for carry, hoping that central banks had their back covers. And now central banks are much more divergent than they've been in the last 7 years.
Let's go back to those three unhinged markets you talked about: high yield, emerging market currencies, and energy. Of those, which has the greatest potential to spill over and infect the U.S. economy?
So they can infect both positive and negative. And I think it's always important to remember that unhinged markets come with risk, but come with opportunities. In terms of risk, all three have, because all three cause volatility to go up. As volatility goes up, the central banks are less able to suppress it, and that causes a reduction in risk appetite, and then you get the contagion that we have seen. But we should also remember that unhinged markets means that prices overshoot and opportunities get created, medium-term opportunities. You see it in the energy sector, you see it in the mining sector, you see it among certain emerging markets, among certain high yield. So this is really an opportunity for people who have patient capital, who can stomach a lot of volatility, and who are really good at name selection. So as much as there's the risk of contagion, we shouldn't lose sight of the opportunities that are being created. And these are opportunities for significant medium-term returns.
So you're just calling the bottom in energy at some point? You're like, buy high yield, buy oil, and buy emerging market currencies?
No, so I'm telling you, and I have an article in the Financial Times today, do not buy the ETF. So do not buy the sector as a whole, because the sector as a whole still has a very bumpy road. But if you're able to get patient capital, including in vehicles that lock the capital in, this is the time to start looking at single asset mining companies, for example. They've been devastated. Absolutely devastated, because they are very concentrated and they're having problems with their cash burns. So there are opportunities. There are certain companies, look at Petrobras in emerging markets, that have been hit really hard. So there are selective opportunities, but this is not the time yet to buy the whole asset class.
Got it. All right. So looking for opportunities in rubble. I guess you could extend that metaphor to your New York Jets, Mohamed. My condolences for what happened over the weekend. How do you spell clutch? It's not Jets.
I mean, if you want to see me cry, just continue on this. I was among with all the other Jets fans devastated, but we remain loyal. We've been there before, so we know what it's like. But it was devastating.